Welcome back to another fundmonitors.com Meet the Manager series. Today I'm joined by Robert Gregory. Robert is the portfolio manager of the Glenmore Australian Equities Fund. Robert, thanks for joining me.
No worries, Damen.
Robert, the Glenmore Australian Equities Fund returned 7.15% for the 12 months to the end of November, beating the ASX Total Return Index once again, as you've beaten it over 3 years, 5 years, and since inception. Do you want to talk a little bit about what's been the driver for this outperformance?
Yeah, sure. Looking at the last 12 months, firstly, there's a couple of things. Firstly, going into the end of 2021, made a conscious decision to exit a number of growth stocks or stocks that I think had quite high valuations. Going into the end of 2021, it became obvious that parts of the ASX were particularly growth and tech, and that part of the market was becoming very fully valued. So that was an area that I thought if we moved into an environment of higher bond rates, that part would be impacted. So part of it was to reduce exposure to that part of the market, which definitely helped returns in 2022. And the other thing that has helped this year has just been exposure to resources and coal stocks. Not when I say resources, there hasn't been a huge resource exposure, but a couple of the stocks that spring to mind would be Mineral Resources and Strandline, as well as a few coal stocks and they've done particularly well during this period of 2022.
Rob, do you want to expand a little bit more maybe on some of the stocks that you have avoided, particularly over the last 12 months? As I note, we compare performance against the benchmark, and it's often the stocks that you manage to avoid that can have a strong impact on the portfolio's performance.
Yeah, look, I guess coming out of COVID, we had a big sell-off in early 2020, and then stocks across the board, re-rated very aggressively. I think bond rates, or central banks cut rates, they were very stimulatory to the stock asset markets generally. So you saw a huge rally in stocks across a range of sectors, back end of 20 and all of 2021. But it just from a valuation point of view, there was certainly stocks in our portfolio, and then stocks just across the ASX, particularly ones that had a growth orientation, where you could see valuation metrics were becoming very stretched. So it was really just a conscious decision to go through the portfolio as we always do, but particularly going towards the end of 2021, go through the portfolio and just make sure that any growth stocks that were in the fund really had really strong earnings growth ability, and that their valuation wasn't too stretched. So that's essentially what we did, and certainly didn't get everything right. Pinnacle was one stock which we continued to hold through 2022, which has fallen quite a bit since its peak of late 2021. But as a general comment, I think we did certainly have much less exposure to the part of the market that's fallen a lot in 2022 than our peers.
Rising interest rates have dominated talk in markets over the last 3 or 4 months. How do you think rising rates will affect your stock choices and how you build your portfolio? And do they change your thinking?
Yeah, look, I think around bond rates, it had a big impact towards the end of 21, because at that point, bond rates were incredibly low and inflation was starting to emerge, just because central banks had been so stimulatory that I think it was becoming very likely that bond rates were going to rise from a really low level. So at that point, and going back to that point about making sure the fund didn't have too much exposure in growth stocks or expensive parts of the market, that was always going to be the part of the market that it was going to be hit if bond rates rise. It was the part of the market that benefited from falling bond rates, and so that definitely was a factor in the thinking probably 12 months ago. It wasn't a huge factor in our exposure to coal and resources. However, it is generally historically, typically resource stocks have done well in a period of high inflation, high interest rates. So that was probably a slight positive in our thinking towards allocating some funds to the resource sector. Right now, in terms of bond rates, it's not having a huge impact, to be honest. I think going to 23, I expect there'll be some rise in bond rates going to 23, but I think it'll be more modest. I think we've had the really big move up this year. You can already start to see inflation numbers coming out of Australia and the US and around the world are starting to moderate. And hence, so I think you'll start to see central banks, moderate their hikes. So as a result, I think we're more in a probably a more neutral sort of position where I think so stocks across the board are probably, I wouldn't say it's a huge growth or value focus right now. I think growth stocks have certainly been sold off very significantly. I think going to 23, it's more a case of stocks need to, have genuine earnings growth options and the valuation needs to stack up for them to perform next year.
That's a great segue into my next question. What are the themes that you're going and ideas that you're going to be looking at over the next 2-3 years?
Yeah, look, I don't think we're going to have a period where either growth or value dominates. I feel like we're in a fairly neutral setting. I don't think growth stocks will get the sort of latitude they've been given in terms of, revenue multiples or those sort of valuation metrics that they've had in that sort of bull market leading up to 21. But so I think it's reasonably balanced. The one part of the market I do find interesting is actually the traditional fossil fuels being oil and gas and coal, because as an investment theme, I think there's probably a slight misunderstanding. I think some people think that they're going to transition, very quickly into a sort of a bear market, so to speak, where oil, gas, coal consumption falls very dramatically. Because I think realistically we're in a more of a transitionary period, which, to be honest, is actually going to go for quite a long time. I think 5, 10, 15 years. Governments can't just switch off conventional and switch to solar and wind farms and renewables. It's just not going to be that easy. So in addition, I think, companies operating in oil, gas, coal, they're not really investing in new capacity because they're terrified of investing because the goalposts are changing. Governments are taxing them very heavily. So there's not much new supply. Demand still continues to be quite resilient. I think we're going to be in a period of quite high prices for the sort of foreseeable future. So I actually think that's a part of the market that looks really interesting, even though they've done quite well the last 12, 18 months. So that's a part that's interests me. Also, I think certain growth stocks, just on the basis that they've been sold off so aggressively this year on the basis of rising bond rates, I think, there's definitely going to be some opportunities in the wreckage. And I think even the last few months, keeping in mind the market's so forward-looking, I think, they've even started to bottom out a lot of those stocks. So I think there's going to be some opportunities there. That's probably the two parts of the market. The other parts, I think, property stocks, they've been hit very hard by the rise in bond rates. Again, I think we're going to have moderation in the rate hikes next year. And often that's all the stock market needs for prices to rally. So that's another sector I think that looks interesting. But I don't think we're going to have a big 5-10 year period of like growth stocks or value stocks dominating. I think it'll be a bit more balanced.
Rob, as always, thank you for your time today. It's been very insightful. I hope you have a wonderful Christmas and that you have a very prosperous 2023.
Thanks, Damen. Yeah, likewise. Good to chat.